Hello and welcome back to another lesson of the Value Investing Bootcamp video course. I have always found it amazing that the average online shopper consults 10 or more sources of information prior to purchase, while many investors seem to blindly put their life savings on the line. You have to put in some effort in order to make the best possible investment decisions, and I am here to help you with that. In the previous lesson we generated a list of investment ideas. These are stocks we need to analyze a bit further in order to see if any of them are interesting companies to invest our hard-earned savings in. We will use two types of analyses for this. The first is fundamental analysis, which simply means that you dive a bit deeper into a company's financial statements to see how well a company is actually performing. The second is qualitative analysis, which has less to do with financial figures and more to do with non-quantifiable data, like the quality of a company's management and the nature of the business. Let's dive straight in. We'll start with some fundamental analysis by taking a closer look at the company's financial statements. This is such a crucial step that some people even say that you aren't really investing if you aren't performing fundamental analysis. We already filtered companies based on return on equity, debt to equity, and current ratio. So what else do we possibly need to know about a company's fundamentals? Why do we need more information? Well, because these ratios do not tell you the whole story. They are merely snapshots in time. We need to look at several years of data and look for patterns before we can draw any real conclusions. Guru Focus provides you with 10 years of financial statement data for free, so this is a great source for the historical financial data we need for this part of our analysis. Go to gurufocus.com, search for one of the companies on your list, and then click on the tab 10-year financials. This page is a pure goldmine of information for value investors, and you should be careful not to get overwhelmed. You really need to know what you are looking for in order to make sense of this mountain of data. So what are we looking for? We are looking for patterns, trends, and consistency in the historical performance of the company. Of course, past performance offers no guarantee for future results, but if you look at the following earning chart, you will agree that you can make a reasonable assumption about the future performance of company A, which shows consistent, stable earnings growth, but that it is absolutely impossible to predict how company B will perform next year, because its earnings fluctuate wildly. We will use the powerful customizable chart on the Guru Focus page to make this pattern finding part of your stock research as simple as a walk in the park. Initially, the chart shows you how the revenue per share developed over time. You preferably look for a stable or increasing revenue per share over time. However, even companies with shrinking revenue could be growing their earnings by becoming more cost efficient or by increasing their profit margins. So let's look at how the earnings per share developed over time. Click on Select a Metric, then Per Share Data, and finally Earnings per Share Diluted. Now, both revenue per share and earnings per share are shown in the chart. To get a better view, remove revenue per share from the chart by unchecking it. Ideally, you see a chart with exponential growth, like this one from Apple. However, you also notice that there is a drop in earnings per share in 2013, and it is exactly these types of unusual situations which you need to be looking for. For example, based on this chart, you can decide to research why this drop in earnings per share occurred and if it is a temporary setback or more permanent in nature. As we learned in the lesson about earnings manipulation, free cash flow is harder to manipulate than earnings. One way to assess whether a company is being honest about its reported earnings is to compare it to the company's free cash flows. So let's add free cash flow per share to our chart and see what we can learn. On average, a company's free cash flows should be in line with its earnings or slightly higher. If a company consistently reports growing earnings while cash flows are way lower, this should be a serious warning sign. This is unsustainable and could be a sign of earnings manipulation and could indicate that a company might soon run out of cash. Now, let's remove earnings and free cash flows from our chart and add book value per share. While book value says little about the intrinsic value of a company, the development of book value over time can tell you a lot. You definitely want to look for a steadily growing book value. This indicates that the company is actually creating value and is becoming worth more and more as time passes. These are the types of companies value investors love. One other thing you want to check is the development of a company's net profit margin. Go to Select a Metric, then Ratios, and then Net Margin. Preferably, you would see a growing net margin, but actually it is already quite an achievement if a company is able to maintain a relatively stable net margin over time, despite fierce competition. A growing net margin indicates that a company is becoming more efficient or is able to continuously raise its prices. A declining net margin is a warning sign, because it could indicate that competitors are stealing away their profits or that customers are unwilling to pay high prices for the company's products or services. Finally, look at the development of return on equity and debt to equity over time. If you see any unusual peaks or valleys, try to find out the reason behind those fluctuations. If they are temporary and manageable, that's fine. But if these fluctuations indicate a fundamental problem with the company, scrap it from your list. Of course, there are dozens of other indicators you could potentially look at, but the ones we discussed so far will give you a pretty accurate picture of a company's performance and financial health. Great! This fundamental analysis will shrink your list of stocks down significantly. Keep in mind though that it is nearly impossible to find a company which fits all the criteria perfectly. Still, try to be fairly strict and conservative in your analysis and drop companies which show too many warning signs. It is now time to step away from the numbers and take a qualitative look at the remaining companies in your list. The first and easiest screening criteria is to see whether or not a company is within your circle of competence, as Benjamin Graham put it. This simply means that you should stick to businesses you understand. If you cannot describe in 2 sentences what a company does and how it earns money, then you should probably not invest in it. Warren Buffett is not shy to admit that he does not understand technology companies. Instead, he invests in simple businesses like See's Candy and Heinz. See's makes candy. Heinz makes ketchup. Simple. However, everyone is different. If you do think you understand technology companies, that's fine. Just stick to what you understand and drop the rest from the list. The next thing to look for is the presence of a sustainable competitive advantage. A sustainable competitive advantage is something which sets a company apart from its competitors and which is not easy to copy. Companies which possess such a competitive advantage are uniquely positioned to remain highly profitable for extended periods of time. This is why Warren Buffett refers to them as wonderful companies. Such companies have been the key to Buffett's phenomenal returns. Here is a list of sustainable competitive advantages and real-world examples. Coca-Cola has such a strong brand name that Warren Buffett once said that if someone gave him several $1 billion to kick Coca-Cola off the throne, he would give it back. It can't be done, he said. There is hardly any company with a more loyal customer base than Apple, which makes it hard for competitors to steal customers away. Once a company decides to use Oracle databases to power its business, it is very difficult and costly to switch to a competitor later on. Patents allow Pfizer to earn above-average returns for several years and protect the company from direct competition. Because Walmart is so big and sells in such high volumes, it has a huge cost advantage because it can produce and purchase products for lower prices than its competitors. A website like eBay becomes more valuable and harder to copy by competitors for each additional user. This network effect is also present at companies like Facebook. The emphasis should really be on the word sustainable, because most competitive advantages are only temporary in nature. Take for example IBM. In the early 1980s, it popularized personal computers. However, competition from Hewlett-Packard and Dell transformed IBM's PC division from a cash cow to a value destroyer. In 2004, IBM gave up and sold its struggling PC division to Lenovo for less than $2 billion. So while technology is cool, it does not provide a sustainable competitive advantage because it is fairly easy to copy. Trends are also something you cannot rely on in the long run because trends sooner or later always end. They are not sustainable. Unfortunately, there is no straightforward way to identify these sustainable competitive advantages. You will have to figure this out for yourself by reading through a company's annual reports and by studying its business model. Another topic which you should spend some time on is thinking about risk factors and things that could negatively affect a company's profitability in the future. This is in line with the thinking of Seth Klarman, who believes that investors should first focus on downside risk before looking at upside potential. Are there competitors which could take a share of their profits? Does the company have a concrete plan to grow its business? Is the market for this company's products and services growing or shrinking? Are there any new laws being put in place which could limit the profitability of the company? These and similar questions should be considered. Companies are required to report risk factors in their annual reports, so this is a good source for inspiration. But also try to think for yourself what could go wrong and look a bit further than what is mentioned in the annual reports. We have arrived at the last major step of our qualitative analysis. In this step, we will assess the quality of a company's management and whether or not they are shareholder friendly. First, check if the company's key executives are not earning excessive amounts of money. Go to finance.yahoo.com, search for a company, and then click on the profile link in the menu to the left. Here you see how much the key executives earn. Next, Google the names of the key executives to find out who they are and what their track record is. Add scandal, fraud, and similar words to your search to find out if they have been involved in anything shady. Finally, analyze the capital allocation strategy of the company to find out how shareholder-friendly the company's management actually is. Use the following rule of thumb. A company with a consistently high return on equity and plenty of growth potential should reinvest a big part of its earnings into the company. Else, shareholders are better off if the company pays out a dividend or buy back shares. I am guessing that was a bit more work than you had expected. Good job for completing it. Let's quickly summarize what we learned in this lesson. You have to put in some serious effort in order to make the best possible investment decisions. Fundamental analysis is assessing a company's performance and financial health based on several years of historical financial statement data. Guru Focus provides you with 10 years of financial statement data for free. Look for patterns, trends, and consistency in the historical performance of the company by checking how things like earnings per share, free cash flow, book value, net margin, and return on equity developed over time. Charts can help you visualize this data to make it easier to spot anomalies, which then require some further analysis. Find out if you are dealing with a temporary setback or fundamental problems which are more permanent in nature. Qualitative analysis is assessing a company's non-quantifiable aspects, like the quality of its management and the nature of its business. Stick to businesses you understand and drop the rest from the list. Look for companies with a sustainable competitive advantage, with the emphasis on sustainable. Think about risk factors and things that could negatively affect the company's profitability in the future. Finally, find out if management is honest, able, and shareholder-friendly. As you can see, it is very rare and it takes a lot of hard work to find a great investment. Now that you have filtered out the garbage, what you are left with is a list of truly great companies. But when should you buy such a great company? And when you finally own it, when should you decide to sell it again? I'll answer both of these questions for you in the next lesson. I'll see you there.